Washington also providing a lift to stocks today. The Senate passing another massive $484 billion relief package, while Fannie and Freddie say they will buy unpaid mortgage loans. Is it all enough, or is still more needed to keep these markets afloat? Joining me now are Neil Hennessy, the Chief Investment Officer of Hennessy Funds, and Michael Kushma, Chief Investment Officer of Global Fixed Income at Morgan Stanley Investment Management. Neil, I'll just start with you. Would you like to see more on the way here?
Not necessarily. I think you have to take a step back, Kelly, and look at a total situation and understand what's happening to the economy and companies. It's material, to say the least, but it's not terminal. I mean, most of the companies are in very good steadfast. The S&P 500 companies have over $5 trillion in cash. There's plenty of good companies out there, but the volatility is giving the investor the feeling that every company on the New York Stock Exchange or any exchange is going broke. And that's so far from the truth. But to hand out money, I think we got to be a little careful on this. The banks are making a tremendous amount of money on the PPP loans, just somewhere, as I was reading, somewhere between 1% and 5% of whatever the loan is the government's paying them. So the banks are just getting stronger during this and taking no risk. So I think we just got to take a breather and say, okay, we just can't keep passing out money.
Well, I know, Michael, you disagree. You say more government support is coming, call it phase 3.5, as much as it takes, and so forth. How much more do you expect or do you think needs to be on the way?
Well, I think what needs to be done is what needs to be done. And our view on how policy making is going to be done is we're going to wait and see how things respond when the markets and economies reopen, economies for goods and services. Because right now, there's no point in providing stimulus to encourage spending when people can't travel, can't spend. So right now, it's about supporting income, supporting the people's ability to buy food, pay rent, and do all those things while we wait for the health situation to improve. And that's when people start going back to work. The question is, how much will consumer confidence have been dented? Will people resume their previous habits of spending money, or will consumers hold back? And consumer spending is upwards of 70% of the economy.
Right.
So if consumers retrench significantly post-reopening of the economy or as it reopens, we will see weakness. And I think phase 4 down the road is going to be outright stimulus to actually stimulate spending in the economy. If consumers won't spend, the government will spend.
Yeah, no, I know. It does seem we're headed that way. Neil, let me ask you, we spoke with Bob a moment ago about how what we're jokingly calling the S&P 10 is really outperforming today, the biggest stocks in the market. The names that you like are more like LPL Financial, NCR, Itron. Why those companies? Would you lean against the big cap trend or kind of ignore it?
Well, I try and look at value and quality, and I look at these three companies. They're in different sectors, but they're all going to be needed. People are going to need financial advice. That's as simple, especially in volatile times with LPL. If you look at NCR, in the scanners in stores or the scanners or self-menus at airports, you're going to need more of those because people want more distancing. You look at Itron, which essentially is smart meters for gas and electricity and water. So these are good, solid companies with low price-to-sales ratios, very good profits, and a lot of room to raise dividends or initiate dividends. So when I try and look at the market, Kelly, and especially the equity market, I said, what do you really want to do? Would you rather own the Dow Jones 30 companies for the next 30 years, yielding almost 3%, or a 30-year U.S. government bond yielding 1.25%?
Well, that's perfect.
It doesn't take a genius to figure this out.
Right. So, Michael, we'll put that to you as the global fixed income guy. How do you make the pitch for fixed income?
The pitch for fixed income is that the results of what happened in March has created lots of dislocations in credit markets. So absolutely, U.S. Treasuries are providing no income, and close surrogates to that, like U.S. agency mortgages, also providing very low yields and very little income. So that's not going to be a place to invest to create wealth or generate income over time. But think of 10-year Treasuries as being a policy instrument of the Fed. Those rates will be driven down as far. And I think the 50 basis point level on 10-year Treasuries is about as low as we're likely to go, barring some further disastrous news on things. But that driving down of those yields is an attempt to drive down and stabilize credit markets. So right now you can still get 4 to 5% on investment-grade corporate bonds, which are companies which should do just fine over the next five years. No doubt that certain sectors of credit markets are dangerous. Energy is one. There's no doubt that there's dislocations going on there that will take significant time to sort out. But in terms of other opportunities, whether in securitized credit, what I mean by that is mortgages not generated by the agencies, non-agency mortgages, you can find a 4 to 6% yield in reasonably high quality things, investment grade things, which is not bad in the current situation.
Yep. No, I take your point. Either way, there's a little bit more yield maybe than people thought was out there. We appreciate you both being here today. Thank you, guys.